The EU hasn't just been organising a €750 billion loan, it's also come down heavily on rating agencies. Politicians, including Angela Merkel and Christine Lagarde, have criticised what they call the premature downgrading of Eurozone sovereigns. They want a review of the rules regulating those firms, but investors are still sceptical. Poppy Trowbridge reports.
What began as a debt crisis exploded into flames on the streets of Athens. Could anyone have seen it coming? Some say the big rating agencies should have, and even made the situation worse. Last week, PIMCO boss Bill Gross said their blind faith in sovereign solvency has led to egregious excess in Greece and their southern neighbours, and they no longer serve a valid purpose for investment companies. Moody's, Standard & Poor's, and Fitch, the big three agencies, have come under increasing opposition for being too big, too powerful, and too opaque. Instead of predicting the future, critics say they've failed to accurately downgrade ailing companies and high-risk sovereign debt. Gross says Spain is a classic example of a ratings rubber stamp. Unemployment just topped 20%, the deficit's at 11% of GDP, and the country has defaulted 13 times in the past 200 years. Spain's rating is AAA. The markets, however, are trading it 7 notches lower. Agencies are now on the defensive about their role.
The role within this very nervous market conditions is, of course, very, very difficult. And when we get new figures which are much worse than before, we need to put it into our calculations and then also indicate whether there's further risk. And we have done this step by step.
When S&P downgraded Greece to below investment grade 2 weeks ago, it made the need for a bailout all the more urgent. Now, European leaders are calling for a review of rules that regulate credit rating agencies.
As a whole, we are going to see an enormous amount of scrutiny faced on the rating agencies as a result of the actions over the last couple of months.
Last week, central bank president Jean-Claude Trichet said more competition is needed to dilute their power. Others say regulators share the blame.
Credit rating agencies are only one part of the market, and we have given them far too much credibility, probably. They are one element, but the trouble is, the ECB is working with them, the supervisors are working with them, so we have given them as much credibility now, and now we would be complaining that they have too much power.
Investors, like those here in the City of London, say that rating agencies only play catch-up, and until their grading schemes can show more skepticism, they say they'll rely on the markets to value a country's debt instead. Poppy Trowbridge, Bloomberg News, London.